Let's welcome in our next guest, Mahantesh Sabarad of SBICAP now joins us. Mahantesh, good morning. First, a view on the Nifty. You had told that there could be a budget rally. Do you think this is the run-up to the budget, or it's just a global rally which India is also responding to?
No, I don't think it is about the global rally that India is responding to simply because the FIIs have net sold quite a few $1 million in the last 2-3 months. So whatever rally that you are seeing post, Christmas seems to be the budget rally. We have rallied from something like almost 8,000 to 8,500. It's a 500-point kind of rally in the Nifty, and we don't see any fundamental support just coming into the market just as yet in terms of what we normally see, which is that there is an uptick in earnings, there is an uptick in the reform process and certain policy initiatives taken by the government, or uptick in trade, etc. So we're not seeing any of those things right now. So whatever we're seeing is a budget rally.
Right. In terms of the rally that we are seeing, it's led by the DIIs. Do you think that if returns don't start to come, will DII flows slow down, and that could be a big trigger, say, if even FIIs are sellers that time?
Yeah, so, what you are saying is right, because it becomes a flow-dependent kind of market, essentially. That is what you are saying. But what I'm really looking for is that even post-budget, there are a few hopes lined up, including the budget itself giving some form of consumption boost, either by lowering income taxes or in terms of allocations of budgetary spends and so on and so forth. And there is also this talk of UBI, Universal Basic Income. So if there is a consumption boost hope, and then you also have this upcoming GST, now there seems to be certain consensus developing, although we're not really sure of it. So we will see the GST rollout happening. So all these together do give a bit of fundamental direction to the market. And globally, US is recovering, UK economy is getting upgraded. Look at the IMF estimates, for example. The world economy is said to do well in 2017. If that is the case, trade momentum will start building up, and India should be one of the beneficiaries of such a momentum. So post-budget, contingent upon how the budget plays out, we might see a continuation of the rally and not really what you were suggesting in terms of a selling trend.
In terms of valuations, last time you told that there is a decent valuation and one can make mediocre gains. Now that valuation support has also gone because of the recent run-up?
Yes, the valuation support seems to have
or become neutral.
Yeah, I wouldn't say it is gone. It's the rally has meant that the valuations have gone up, and they are not too comfortable as it was the case before. And when you don't have the earnings support that we are talking of, that means there are no further upgrades likely. In fact, if at all, there could be downgrades. In such a situation, the market will start trending to become a little more expensive ahead. So having said that, what essentially I'm trying to tell you is today we have seen the rally. It seems to be in its last leg of the rally. The earnings momentum is not there, but policy direction seems to be positive post the budget, and therefore the market can continue to remain in this 8,400, 8,500 Nifty levels ahead.
Right. The mid-cap space, are you surprised by the sell-off that the market saw, and then again the sharp recovery that is seen?
It was bound to happen because mid-caps are by nature volatile. Demonetization affected only a few mid-caps, not really all. And what we have also seen is, and what is more important for a lot of mid-caps is, they are indebted, and when interest rates are falling, you find that these mid-cap names can tend to do well. So it had to be a selective rally in certain mid-cap stocks. That is what we are seeing. We are not seeing the mid-cap rally consuming it's not an all-out kind of trend for all the stocks. So there are a few stocks which are still down and under. Only some of them have rallied. So we have to be basically in the stock picking mode really to say that this set of mid-cap stocks are going to do well.
Right. As far as overall mid-caps are concerned, do you think valuations for mid-cap versus large-cap, any tactical call, or you think it has to be a mix of both if somebody is looking to make a portfolio?
It has to be a mix of both, because the valuations do not trend to move in tandem all the times. Like I just referred right now, the policy directions of the government typically will mean that the large cap stocks tend to outperform the mid cap stocks because there is a valuation boost given by the policy direction. But at the same time, like I said, that if interest rates are going to soften and there's going to be a little bit of consumption boost coming in, then we will see some of the mid-cap names actually start performing really well and their valuations going up. So, for a portfolio build-up, therefore, you need to be very selective, have a mix of both the stocks, but the recommendation generally would be to overweight your portfolio with the large cap names right now rather than the mid cap names.
What would be your top picks? Let's start with the large cap names. Where are you recommending a buy call?
So among the top picks, we are recommending a few of the bank names, particularly in the private space. So it is the Yes Banks and the Axis Banks of the world. In the large cap space, some of the automobile names, Maruti, for example, is something that we are recommending. If in the IT space, it is a few of the names like an Infosys would be a buy. If you go to the mid cap space, then there are a few stocks that we are looking at. Some of these names include Glaxo Consumer, for example. Some of them include.
Let's just talk about them one by one. So private banks, you said. We've got numbers from IndusInd, we've got numbers from DCB. So something like a Yes Bank, which declares tomorrow, you don't expect a meaningful impact because of demonetization? Street was slightly over-concerned?
Okay, when you look at these two banks, which is DCB and IndusInd Bank, so there is a slight difference in the results that have been announced, and then I'll refer to the NPA numbers. IndusInd has seen a marginal uptick in their NPA numbers, though not significantly high. On the other hand, DCB Bank has seen a fall in its NPA numbers, but DCB Bank also has seen large slippages. So having said that, what we are looking at in the banking space, particularly those which are focused more towards the consumer banking rather than corporate banking, and which most private sector banks are into, we think that the results momentum will not be particularly affected by the demonetization kind of drive, because people, even in the demonetization phase, consumer-centric loans were not really facing stress. The agricultural, for example, loans were facing stress, which is the domain area of most of the public sector banks. But there, the RBI has allowed a window, that means the NPA recognition window has been widened. Private banks, it's out and out consumer banking. Consumer banking with adoption of more digitization is going to be a very healthy trend for most of these banks. So that is what we are looking at. Valuation wise, in a falling interest rate environment, there is a scope for re-rating in many of these banks, and therefore they appear very attractive.
Right. As far as NBFCs are concerned, do you see value over there after correction, or the point that you were just making that some of them can be consumer facing would mean that their numbers would not be that bad?
Which is what we therefore recommend in such NBFC names as housing finance companies, not really any of the gold financing companies, or even the automobile, within automobile the CV financing kind of companies. So it's the home finance companies which trend to do better. Canfin Home is a very good example. It went through a steep fall. If you look at its last 3-4 months, price chart, it fell very sharply and has recovered equally sharply as well in the last 3-4 months. So
some of the numbers from NBFCs, especially housing finance companies, are good.
Some numbers are yet to be seen, but we expect that the quarter results will turn out to be better.
Right. About Infosys, you mentioned you're not concerned about the results, the guidance that they have given. You think it's pure valuation call for a good company?
Yeah, it's a valuation call for a good company. Mind you, the guidance which has been lowered is now, since we are into the third quarter, we have finished the third quarter, the guidance lowering is only meant for one quarter. What is more important is the guidance ahead, which is starting May. They will sometime in April, May, they will come out with their guidance for the full year ahead. So I think that's the time where we think that the earnings trajectory of Infosys, which has been largely in that 8-9% kind of range per annum, would go to the 12-14% range very likely, if not in FY18, very likely in FY19. In the interim, yes, there will be pressures coming in from the Trump's policy on review of H-1B visa. But for a company like Infosys, there are other avenues to continue their services in the US market. And while the cost can potentially go up, the business opportunities rise much faster. So we are looking at that kind of situation playing out.
All right. So we've spoken about stocks and sectors where some of the earnings have already come through. Let's also talk about Reliance. When we see Reliance numbers, the GRMs are good, but they were not. The overall earnings were largely in line, nothing spectacular. But they did make the mention of increased investments into Jio. What's your view about Reliance Industries as well as the entire oil and gas pack? What can we expect when the third quarter earnings come out?
Okay, let's talk of the Reliance results. Okay, what we were concerned about were two things particularly. One of which you mentioned, which is the large investments going into Jio, and the commensurate returns, which was expected to start from January, seems to have been further delayed by a few months. So that's a bit of a disappointment. The second bit that was disappointing for Reliance is if you look at its volumes, be it refinery throughput, be it oil and gas production, or be it even the petchem business, all round, or even oil and gas exploration abroad, the shale gas for them, all the volumes are sequentially down, and the trend seems to suggest that it is going to remain further down. Whatever gains the company has happened to made was top line driven. There's a huge top line growth because of the prices, and therefore some bit of GRM push that has yielded better results. So all in all, what we are seeing is while the result met the expectations, the underlying strength of the company's core business seems to be a little shaky, and there is a huge investment in Jio. Look at the debt; it has from the March situation to the December situation, the debt seems to have ballooned further. So things are getting a little scary.
Right, that was for Reliance. What about the other oil and gas names, notably the oil marketing companies? We've seen an increase in crude oil prices in the third quarter. Do you think there will be some inventory losses? How would you assess the oil marketing companies?
So if you look at what happened with most of these oil marketing companies in the last 2 years is that the softer crude prices reflected into better margins for most of these companies. So there have been, I think a couple of these names have been multi-baggers in the last 2 years, the oil marketing company. But is that what the situation likely to be ahead? Then their answer is possibly no, because the crude oil prices are rising. And one of the effect of that rise in crude oil prices is seen in the form of inventory losses, which you just mentioned about, and which the results will throw up such numbers. We haven't seen the result as yet, but the likely expectation is that. So from a trend perspective, for most of the oil companies, we think the rally in the stocks are done with. Probably they will move sideways ahead, and there could be a situation where they can even fall down. So all in all, for the entire oil and gas sector, so there are three parts that we look at when you look at the oil and gas sector. One is on the E&P side, which is the upstream kind of companies. Then we look at the downstream companies. Within downstream companies, we look at two kinds of companies. One is the oil marketing companies, and then there is the gas distribution companies. All the three pieces in a rising oil environment, rising crude price environment, doesn't all the three do not look really great, and more particularly we are getting a little bothered on the gas distribution companies, some of which are trading at far too rich valuations. So all in all, the sector doesn't seem to have legs ahead for a rally.
That's the oil marketing companies. What about some of the capital good companies? Larsen & Toubro has done well in this recent rally, and we are seeing a big move coming into BHEL as well. While there is a general belief that private sector capex is not picking up in a hurry, and in the power sector also we are seeing quite a lot of overcapacity. Power rates have gone down quite a bit, and renewable energies picking up very quickly. What is the view on these two counters, BHEL and L&T?
So on the within the capital goods companies that you alluded to one section of their business, which is really power. Now, yes, you're right. In the field of in the power sector, the way the planning authorities have come with numbers shows that there is no fresh thermal capacity, virtually no fresh thermal capacity going to come in the next 5 years, barring the ones which are already in their either the design phase or who have gone through their approval phase or the construction phase. So there is no fresh impetus coming from absolutely fresh projects coming into the field. So by that logic, the order visibility for a BHEL in the years ahead is dwindled. But at the same time, the order visibility excluding X of thermal power, there seems to be great opportunities coming up there, and wherein a company like L&T stands to benefit because it's far more diversified. It's also into construction of roads and other infrastructure. It's also into products and it's also into projects abroad. So all in all, between the two, L&T does appear far better in terms of its outlook. So BHEL again, barring the only thing that works in favor of BHEL right now is that its valuation wise appears very cheap, and the valuation is not the classical PE multiple that we look at. We look at its order book size, and we assume that most of the orders will eventually come, although there are a few non-moving orders within their order book.
What's your view on the cement space? Today we're seeing a decent up move coming into Ultratech, Ambuja, ACC. When it comes to earnings, do you think Q3 will be disappointing, or could we see some positive surprises?
So for cement earnings, there's always this problem. Prices go up for cement, but costs are also shooting up. Or you have the reverse situation. Prices are going down, but the volume shoot up. So therefore, by nature, these companies are, unless and until both the volume growth trend and the pricing trend, coupled with the costing trends, all three converge to sort of deliver better margins for them, cement company stocks are not going to really do well ahead. So right now what we are seeing is that volume trends seem to be on the upswing because there is a general economic recovery taking shape. Policy thrust will be such that there will be huge construction activities upcoming, more particularly in individual house builds through the Prime Minister's Awas Yojana and similar such schemes. But there doesn't seem to be sustainability of prices. And at the same time, costs are now rising, more particularly on the fuel side. So we're not so very bullish about the cement stocks ahead.